Hey, by the way, this is changing. Did I tell you that?
Yeah, you told me you're going to start using some kind of lotion and generating
everything.
yourself.
I am going
Eat fruit,
I'm gonna
candy.
pick some weight up. I'm gonna put some weight down, and then I'm gonna eat some greens. I'm gonna get some proteins.
Okay.
I used to be pretty jacked. I don't know how far back you go, but prior to Jazz, I was jacked. I was working out with this guy that was like Arnold Schwarzenegger, man.
Yeah.
And we did some things, man.
There you go.
I'm back in.
There you go.
Speaking of back in, glad to be back in. Don't know where I'm looking at the moment, but this is cool.
Yeah, we got a lot of cameras.
You got your joke ready?
No.
Oh, he's gonna need to look for a joke.
I'm off the path today.
If you don't find a joke, we'll start over, man. We got to do it.
So actually, I got one. I got one for you already.
Okay.
So.
Good. All right. Are we saving it?
Yeah, oh yeah.
Oh, thank God. All right, is the market going higher or lower from here? This really hits home to me because I can show you things, everything that's actually panning out. And if you watch the closing beat, we actually started doing this early last week, going, hey, market can't go higher because of this. Hey, market can't go higher because of this. And when it broke out that brief moment ago, you see where all the volume's at, it's likely going to be a fake out, and here's why. And look where we stand right now with a solid fake out in the market. This pullback may be buyable, but it at least hopefully stopped you from buying there. Now, bigger picture, we get clients that go, hey, you're not using 100% of the cash in the funds. When are we going to invest it? Oh my God, I want to get in the market. What part of this market makes you say, you know what, I would like to swing for the fences and be 100% in the market? Like, convince me, convince Eric. That's like, I'm getting passionate about it because I would love to know if I'm missing something. You know, we manage our own funds here, and so we want to have the best performance we can, but we also want to limit the downside when possible, and that's what we've been doing here for now a year.
Yeah, the emotional roller coaster that you're on, as much as they say, remove emotion, remove all emotion, we get it. You know, we're all human, and there's going to be emotion. And if you're one that views your account on a daily basis, you know, a little movement, okay.
Fine.
But if you're riding this roller coaster, the seesaw, and you're 100% in, and you're seeing, hey, cool, today I've got $1 million. Awesome. Tomorrow I've got 1.1. Yep. The next day I got 998,000, and it's not maybe that quite that drastic, but it's moving. And it's like, as advisors, yes, we want, performance is a big key of things, but it's also helping to make sure you're making the right decision with your dough.
Sure. And not to be sales pitchy here, but take us out of the equation for a moment. Any wealth manager, advisor, investment manager, whatever you want to call them, if they're helping you with that, okay, that's part of the service. They should, of course, be helping with planning and all that stuff. But at the end of the day, they want to sort of smooth out the volatility in your account while showing the best possible return. Some are better at it than others. I feel like I'm pretty good at it. I'm just saying.
But you're working out again, remember?
Well, that's right. Yeah. Things are happening. Might have taken some fish oil too. But the point being that why would an advisor want to smooth out your returns or your volatility, I should say? They don't want to hear from you. And that's we just learned that at this conference. You know, they want you to quietly go do your thing. But respectfully, it's
to go golf as well.
Yeah, golfing is what we learned.
What business are we in? We're not golfing every day. They told them, advisors should be out meeting people in the golf.
We didn't figure it out. Like, we learned a lot, man. We're just not going to work anymore. That's what we learned. No, just kidding. But the true reason is we're trying to stop that emotion. If we can stop you from making emotional, stupid moves, then you're going to get to the end with better returns and not feeling so, I wish I didn't do that sort of thing.
Yeah.
So today, we want to share some of that data with you. I will pitch, and Eric, you can join along, but I will pitch my reasons why there's just no reason for the market to blast off higher. And I'd be very curious, comments below, if you think that I'm off base or that there's something that could come up to cause the markets to go higher. On the screen, number one,
boom.
We've got some slides here for you today. We can see that all of the individual stock traders that you guys that said you went from, I want to invest in the index, and then, the stocks started taking off and you're like, I'll pick some individual stocks. We can see you did that here all through COVID. This is the net individual stock positions that people bought in the S&P and the NASDAQ. Lots of individual retail, that's you, stock picking. Well, we now can see that you guys have all changed your mind, have gotten out of your individual stocks, and have returned back to individual ETFs. So slide number 3 here. We know now that retail investors since the end of COVID have been shifting back into ETFs. In other words, you went from stock picker to you can't beat the index. Let's just go in the index. So hope it worked out well while you're playing the stock game. But we see that.
Everybody everybody did the tax loss harvest. They're like, yeah, well, I had 100, now I've only got 50. And it's like, darn it, well, you know what, all these tax loss harvests, throw it in the ETF and I'm done with this.
Yep. I didn't get the stimulus payment thing, but when I found out that was a thing, I'm like, if I get it, I was going to go put it on that Disney position I've had forever. Thankfully, I didn't, because I still have the stinking thing.
Yeah, I can't get rid of it.
Yeah, I keep selling calls, and it's like, just go away. Nothing against Disney, the parks, the company, different story. Okay, but so people moved into ETFs, right? We know that. We know you've become more passive. If we shift even further down, we can see that in that money, you took out from your mutual funds, those of you that played it slow and said, well, I'm just hanging out in mutual funds. You now have decided to take less risk. And where'd you go? Like literally $600 billion has moved into money market funds because you didn't want to take the risk in the first place. Now you get 4 or 5% on that money market stuff. The money's moving there. That's less money that can go in the market and get excited on a given day or week or whatever and push the market higher. Notice how we don't see these blast off days where it just goes. The next day it goes. And you're like, who's buying this? Yeah, we don't have that kind of money anymore. And I'm just now getting into ramble mode. Stop me.
No. But I think you're right. But there is the money that's in the money markets, but the people aren't sold on this market. So it's sitting there right there.
Part of that.
And it's like, hey, I've pulled some cash to the side. At what point am I getting in? They're really doing kind of what we're doing.
What we're talking about.
It's like, hey, we've got still some cash positions. Let's let this level out a bit. There's too much, weird economic data out there. There's the debt ceiling. There's
political risk.
There's all of these different things, and then still the Fed. We're waiting to hear what happens in the summer. There's too many underlying factors of why the market shouldn't just run away.
Yep.
And when it does, we're back to what we've seen.
We'll see it here too.
Another year of this. We've been going at this well over a year of, a rally up, a pullback, a rally up, a pullback.
And we'll see it. Like right now, we see money in money market funds. Those are two different types of people. Those are people that want safety and cash. So why do you want to go against the grain if you think that way? And number two, that's people that said, I'm 65 years old, but 3 years ago, if I wanted even a 1.9% yield, I had to be in the S&P. At that point, the S&P was the highest yielding product on the planet. Like you couldn't get a higher yield. Yeah. Well, the trade-off is that risk, the craziness. So we have those two people going into money market funds right now. That is less dollars going into the market. We need dollars to get the market to go up.
But there is the factor with this, and this is because some people are going to say, well, let's just push it all to the money market fund. But not knowing, at what moment, because we've also talked things like, the best 10 days in the market that you're going to make.
Yeah.
Things like that. Or the idea that this money market fund isn't always going to pay things like that. These high yield savings aren't always going to do this. And there's going to be the point where they drop and things have to start shifting back to something else.
Yeah.
And also, long term, generally speaking, a money market's just not going to do anything comparative to inflation.
And think about a lot of our clients are close to retirement or in retirement. Think of those people. They don't need a blended 8% return or 10% return before inflation. They need, with the plans you figured out, they need a blended 5.75% return. Okay, what's the least amount of risk we can take to get that? We need some money in the market, but now with money market funds paying 4.7, 4.8, and 5, wow, we can get a lot of that return there, take very little risk over here, and any little bump in the market will help us out.
But then realizing when to get back in is going to be the key on this.
If they need to.
We, just had that person the other day. So they needed some growth. We talked to him. I chatted with him on email quite a bit and helping him to understand that. There's some fear in the market, and it's understandable. There's a lot going on. He sees that, but it's like, let's help with the emotion side of things. You do have a money market opportunity, but also making sure that you're removing the emotion, because when the market's actually going down, you got to start shifting this. I mean, that's what we've done over the past year. We're still looking to do. Shift money to the markets, because you got to buy when it's going down, and that's the opposite of what anybody wants to do.
I got to tell you, man.
Or not anybody, but
I'm like all fired up about this. Like, no, look. And here you are like, well, we've got to think about this. Think this through. You could tell he's got the younger kids, right? So
younger kids.
quickly on just globally, this is happening around the world, right? So equity movement in terms of dollars going in and out of equity funds in the stock markets all around the world, slight decline. Well, we need more money to get it to go up, just like anything else. If 10 people are bidding on a classic car, the price will go up faster. If one person is, he's not going to outbid himself very fast, right? It's a whole different game.
Yep.
We've got money moving into bonds since the beginning of the year, ever so slowly there. And of course, the uptick in money market. So we're talking, again, hundreds of billions of dollars. That's people around the world saying, I'm just not 100% sure here. And also, I can get a higher yield and not take any risk or no real risk. Yeah, let's do that. Sounds good.
Yeah.
I'll also add to that, sell in May and go away. I shared this on the closing beat here. Here is the rolling returns, literally by day, throughout the entire year going back to 1950. We typically see a bang to start the year. That first couple days of the year, it's the most volatile of the year, highest volume, by the way, usually, unless there's like a flash crash or something. And obviously, we talked about this going through February or slight pullback, but we have a positive average return through that first part of the year until we get to May. During May, the sell in May and go away is essentially where we see that weakness initially in May and kind of bleed through. Not so bad this go around, but we do see the weakness coming in, and that's one of the other headwinds, to sound fancy, that you're going to be faced with. People know this. This is not a surprise, and so if we look down here, we already have that volatility priced in, meaning we know, if you look at the dark blue line here, we know May is going to be more volatile and maybe to the downside. So this is the actual money being bought in the volatility markets. You can bet on the market being more wild or less wild.
Yeah.
And so when you look through, for example, June, we know that in May and June, volatility can be there. It's the start of the summer. Everybody's making decisions before they go to their summer Hamptons house or whatever they do. We know July, it calms down. No one is really betting that July is going to be a massively volatile month. We expect that to already go through. In August, everything's calming back to normal. So if this is not for me to suggest something to you, this is to say, this is what the big money is doing. This is their actual bets that you are looking at here. And so far, they've been right, because now I'm going to show, I got the volatility there. We're at 21 today, so it's a little off. But this is the previous chart that we just looked at. And does it correlate to what we're actually seeing? We expect volatility to increase in May. People are making those bets. And what's happening to volatility? It's actually going up. So their bet's good for them. You know, they're making a few dollars. And so that's pretty cool.
Yep.
So handful of things to put together a thought of like, hey, Warren Buffett's sitting in cash. All right, it's Warren Buffett. Everybody's like, you know, you're not Warren Buffett. Okay. Look at everybody else. Like Peter Thiel, they were having a hard time getting him to invest in some of these late startups here. Okay, look at everybody else. They're wanting to be patient. They know that the risk is to the downside. It is not to the upside here. And once you understand that saying, it really starts to click. Like, okay, that's where my risk is at.
Yeah.
Let's not participate in that.
No, absolutely. No, I like it. I like it, man.
Gotcha, man.
I think you just made the argument.
Good. I hope so.
That it, you know, people, just what you say, you know, why is a little bit of it in cash? Why are we doing the cash thing?
True. I love it.
Patience is key. So I was chatting with my wife the other day, and
I don't think you were.
She told me I was immature.
Okay.
So I kicked her out of my fort.
I gotcha. That's more along my speed there. I like that one there. I was thinking the other day, like, if you're traveling at the speed of light and you turn your lights on, does anything happen? It's not a joke. That's a thinker.
That's a methodical thinker.
Classic Stephen Wright, man.
Yeah.
That
guy.
He's the king, man.
Yeah.
In his world. You know, there's another new guy that's doing it, and he's kind of funny and stoner-like about it. Okay. Stephen Wright was just, I'm a homeless guy. Like, he just so dead looking on the outside. Love it.
Nice. Well, good work, man. I like this.
Thank you.
Nice work on putting out the charts, too.
Thank you. I was up all night.
You were.
Did it. Made it happen. Had some help.
Yeah. There you go.
Yep.
New jazz team.
Could be. We'll see. Always networking out there.
Working to grow.
I love it.
Awesome. All right. Well, thanks for joining us. And what do you always say? Adios.
Adios. Get your damn dough straight, man.